And we were just discussing the market sentiment, how you would characterize that.
Yeah, so it was a very, very difficult 2022, I think, for almost everyone. And then we saw positive developments on the macro side. It's US inflation, it's global inflation, it's China reopening very, very quickly, an energy crisis in Europe that is not as bad as many feared, and lots of also EM-specific developments surprising on the positive side. And so if you take these marginally positive developments on the macro side together with this downbeat sentiment, many people sitting on cash, it just needed a little spark to really move money back. And a lot of that money went to emerging markets, it went to China, it went to cyclical stocks in Europe, etc. So I think overall we're in for a good start, and we'll have to see how long it can last.
So, okay, I want to know more about where this money went to, because a lot of the conversations have been around attention being moved away, or being, let's say, portfolios being underweight in US equities and moving towards other asset classes. So how would you characterize this in terms of asset classes? You've mentioned emerging markets, Asia. Give us more details.
I think exactly. On the equity side, clearly the cyclical parts, emerging markets, China specifically, which seems to be in a different part of the cycle than, say, the US, which is really like decelerating. They really benefited in terms of flows. But the other big thing clearly was fixed income. I mean, many people saw yield levels on very defensive, say, US Treasury bonds or other defensive bonds that they haven't seen in more than a decade. And it was just too high to resist. And so we're seeing money moving back into fixed income, and people really eager and keen to build allocation. As said, they haven't done that in a long, long time, and that's also where we as a house see one of the bigger opportunities right now.
And what about cash? What's the position on cash at the moment?
I mean, on our side, we typically don't sit on cash. We have our money working for our clients. That's what we're supposed to do. But clearly, if you've asked about cash and defensive allocations, we've moving back into more risk assets. We've, upgraded emerging market equities to overweight emerging market bonds, commodities as well. So we're really tactically starting to allocate more money into those sort of more risky positions out there.
And when it comes to China's reopening, now that obviously has an effect on a lot of emerging markets. What is your sentiment in terms of the investment flows towards emerging markets, and what has been the effect of China's reopening?
So I think on the economic side, clearly we need to distinguish between China today and China 10, 15, 20 years ago. I mean, in the past, first decade of this century, you could explain the RAN really well by just looking at China. Right now, the composition of growth is very different in China. There's more consumption, there's less investments, and hence, at the margin, this is still very beneficial for South Africa, but it's relatively speaking less beneficial than in the past. But still, I think overall that's positive. But if you look at a South African economy that may grow 1% this year if everything is fine, versus say China that can grow 5 or more % this year, then clearly as an international investors you would probably rather look at China first and then South Africa a bit later, I'm afraid.
Now, aside from growth of the country and the economy, how do you look at, let's say, local macros such as load shedding? How does an international investor perceive the current energy crisis that is happening in South Africa?
Yeah, I mean, we were used to look at load shedding for a long time, but now it's sort of, for me as an outsider, it seems it has reached a level that really starts to hurt economic developments, right? So it's one thing if the robot is off and you have to wait a few minutes longer until you're home, but now you're seeing companies suffering, they need to cut back. You're reaching limits in terms of battery storage capacity, et cetera, et cetera, et cetera. So I'm not here to tell the South Africans how to deal with that, but as an outsider, I'd say this is probably the time similar to what we did in 2020 when we were suddenly hit by this pandemic, that we need to act pragmatically. There is plans and concepts and everything, but now I think it's really, really important that the country can get this sorted as quickly as possible and everybody sort of working together, because it starts to become really a drag on the economy and hence also on the way we think about opportunities as investors in this beautiful country. And
you don't see it priced in to a certain extent?
I think the RAND, for example, the local assets, they've been lagging. But again, if you see the delta, the positive development so much bigger elsewhere, again, say China, then clearly we would rather look there first and then it maybe come later back to South Africa. We really want to see some positive development here And I think you can actually still do that, so we can still be optimistic.
Ending on a positive note there.
Yes.
Michael, thank you so much for joining us and for sharing your insights. That was Michael Bolliger, Chief Investment Officer, UBS Global Wealth Management.